Stock markets continue climbing upward with artificial calm. Delivery apps still promise convenience within minutes. Cafes remain crowded with remote workers tapping quietly on expensive laptops. Airports overflow with tourists moving between continents as if prosperity itself has become permanent. And somewhere high above the streets of Toronto, inside a glass apartment tower overlooking the skyline, a young couple sits in silence at a kitchen table, lit only by the glow of a phone screen. They are looking at homes they already know they cannot afford. The apartment is small, the rent is enormous, yet even after years of saving, after university, degrees, stable jobs, and careful budgeting, ownership feels less like a milestone and more like fantasy. A modest home costs more than their parents earned in decades. Still, they keep scrolling, because modern life trains people to believe the answer is always one more year of work, one more promotion, one more sacrifice, and perhaps that is the first illusion, because humanity has never been richer than it is right. Now, never more technologically advanced, never more productive civilizations once fought over farmland because survival depended on harvests. Entire kingdoms collapsed from droughts, disease, and failed trade routes. Today, machines can communicate across oceans instantly. Artificial intelligence can generate worlds from text. Satellites circle the planet continuously. Humanity split the atom, mapped the genome, and built economies so vast they operate 24 hours a day without sleeping. And yet, millions of people cannot secure a place to live. Not luxurious homes, not mansions, just permanence. In London, finance professionals earning six-figure salaries rent apartments barely large enough to raise children. In Seoul, adults remain with parents into their 30s because ownership has drifted beyond reach. In Sydney, workers travel hours from distant suburbs because the city itself has become economically inaccessible. Different cultures, different languages, different governments, the same result. And that is where the story becomes unsettling, because isolated crises are easy to explain. One country can mismanage policy. One city can experience speculation. One government can fail its citizens. But when the same housing crisis emerges across capitalist economies, socialist systems, democracies, monarchies, and authoritarian states simultaneously, it stops looking accidental. It begins looking systemic. As night spreads across the modern world, cranes continue moving above skylines like giant mechanical creatures, building monuments to invisible wealth. Luxury towers rise endlessly into the clouds, while ordinary workers quietly disappear from the neighborhoods they once sustained. Teachers leave cities they grew up in. Nurses commute from distant towns. Young couples postpone marriage because permanence feels financially impossible. Entire generations now experience adulthood as something delayed indefinitely, and perhaps the strangest part is how normal this has become. People speak about million-dollar homes the way previous civilizations discussed weather patterns, unavoidable forces beyond human control. But housing was not always like this. For most of history, shelter existed primarily for living. Today, something feels different. Because the modern housing market no longer behaves like a market for homes, it behaves like a machine absorbing salaries, reshaping cities, delaying families, and concentrating wealth upward with astonishing precision. The deeper you look, the stranger the pattern becomes. Governments publicly promise affordable housing while quietly celebrating rising property values as evidence of economic strength. News anchors describe exploding home prices as good for the economy. Politicians fear housing crashes more than housing inflation. Even homeowners become psychologically trapped. A family watches the value of their house double over 10 years and feels wealthier. Their retirement appears safer. Their future appears more stable, but hidden inside that optimism is another reality entirely. Their children may never afford the same life. Prices keep rising. At first glance, it feels irrational. But what if it isn't? What if expensive housing is not a failure of the modern system, but one of its requirements? That possibility changes the entire story, because most people still think houses are fundamentally homes, places for families, places for memory, places for stability. But somewhere over the last half-century, homes quietly transformed into something else entirely. financial assets. Collateral. Investment. Vehicles. Economic fuel. A civilization built enormous portions of its economy around the assumption that property values would continue rising forever. And once that happened, affordability itself became dangerous. Not politically dangerous, economically dangerous, because falling house prices no longer threaten only homeowners. They threaten banks issuing mortgage debt, pension funds relying on asset appreciation, governments dependent on property taxes, consumer confidence, construction industries, national growth statistics, modern civilization, quietly fused shelter with finance. And once shelter became financial infrastructure, the incentives changed permanently. That is why cities around the world increasingly resemble each other economically, even when they appear culturally different. Glass towers rise. In Dubai, investors buy empty apartments. In Vancouver, workers in Singapore sacrificed decades of income for tiny living spaces. The same invisible pressures repeat everywhere. It feels as though humanity accidentally built a civilization where homes became too important to ever become affordable again. And perhaps that is the real fear hidden beneath the housing crisis. People are not merely afraid of renting forever. They are afraid of becoming economically invisible because ownership has always represented something deeper than property itself. It represents permanence, stability, identity, the ability to imagine a future that belongs to you. Without that, societies begin feeling psychologically unstable, and history contains warnings about what happens when populations lose faith in permanence. Ancient Rome experienced extreme land concentration before decline. Feudal Europe tied survival directly to property ownership. Every civilization eventually reveals what it values most by what it allows ordinary people to secure, which raises a disturbing possibility. Maybe the modern housing crisis is not simply about supply and demand. Maybe it is revealing something much larger about the civilization humanity has built. Because tonight, somewhere in the world, another young couple is refreshing apartment listings they cannot afford. Another family is delaying children because stability feels impossible. Another worker is spending half their income just to exist near opportunity. Life still appears normal. The lights still glow. The markets still rise. But beneath the surface, something fundamental has changed. People think they are chasing homes, but what they are really chasing is access to stability itself. And to understand why homes became impossible, you first have to understand when shelter stopped being shelter. Long before modern banks existed, before skyscrapers, mortgages, or suburban neighborhoods, humanity already understood one brutal truth: whoever controls land controls the future. In ancient civilizations, ownership was never merely economic. It determined survival itself. Land controlled food production, military strength, taxation, inheritance, and political authority. Kings did not measure wealth through digital numbers on screens. They measured it through territory. And ordinary people understood something deeply psychological about land. Long before economists ever described it in textbooks, a person without permanence is easier to control. In the late years of the Roman Empire, wealthy elites accumulated enormous estates, while ordinary citizens slowly lost access to independent ownership. Small farmers disappeared beneath expanding concentrations of wealth. Families who once sustained themselves became dependent on aristocratic systems they could no longer escape. Historians often describe Rome collapsing because of invasions, corruption, or military decline. But beneath those explanations sat another force quietly destabilizing society from within: land inequality. The pattern repeated across centuries because housing has never truly been just about shelter. It has always been connected to hierarchy, power, and permanence. In feudal Europe, peasants did not simply lack money, they lacked stability. Most people lived on land they would never own, serving nobles whose authority came not only from armies, but from inherited control over physical space. To own land meant your bloodline had continuity. To lack it meant your existence remained temporary. Even language reflected this reality. Terms like estate, property, and inheritance carried emotional weight because they represented more than wealth. They represented belonging, identity, future generations. For most of human history, ordinary citizens never expected widespread ownership. The idea that factory workers, teachers, or clerks should naturally own private homes would have sounded absurd to ancient civilizations, which makes the 20th century one of the strangest anomalies in history. Because after World War II, several Western nations accidentally created the most accessible housing era humanity had ever experienced. Factories that once produced military equipment shifted toward consumer economies. Governments subsidized infrastructure. A brief moment where industrial expansion, demographics, cheap energy, and government policy aligned simultaneously. And perhaps most importantly, finance had not yet fully consumed housing. Homes still functioned primarily as places humans lived. This era permanently reshaped cultural psychology. Across films, advertisements, and political rhetoric, the suburban home became sacred symbol. A detached house with a lawn represented adulthood itself. Marriage, children, stability, and moral success all became psychologically tied to ownership. Governments encouraged this vision enthusiastically because homeowners were politically stabilizing. Citizens with appreciating assets felt invested. In the future, rising home values created optimism, consumption, and long-term financial behavior. Entire economies discovered they could generate social stability through expanding ownership. Banks discovered something even more powerful. Mortgages created decades of predictable debt. A 30-year mortgage transformed shelter into one of the most profitable financial products ever invented. Unlike short-term loans, housing debt tied citizens to banking systems for enormous portions of their lives. At first, the relationship appeared mutually beneficial. Families gained homes, banks gained profit, governments gained stability. Everyone appeared to win, but hidden beneath the surface, a transformation had quietly begun. Homes were slowly mutating from shelter into economic infrastructure. Then came the 1970s, and the financial world changed permanently. The collapse of the Bretton Woods monetary system severed the dollar's relationship. With gold, global finance accelerated. Debt expanded rapidly. Deregulation intensified through the 1980s. Capital began moving internationally with unprecedented speed. Money itself became more abstract, and housing changed. Alongside it, what once functioned primarily as local shelter increasingly became global. Asset class, this transformation happened slowly enough that most people never noticed it. Occurring in Tokyo during the late 1980s, property speculation inflated so dramatically that land beneath the Imperial Palace was famously said to be worth more than all the real estate in California combined. The numbers sounded insane, but the deeper insanity was psychological. People no longer purchased homes primarily to live in them. They purchased them because they believed prices would continue rising forever. In New York City, financialization reshaped urban life itself. Real estate increasingly became intertwined with global investment flows. Entire neighborhoods transformed into speculative zones where property values mattered more than communities. Meanwhile, in China, rapid urbanization and privatization turned housing into one of the primary engines of national economic growth. Families poured savings into apartments not merely for shelter, but because property became one of the few trusted methods of preserving wealth. Different cultures, different political systems, same trajectory. Housing evolved into wealth storage, and once economies became dependent on rising asset prices, a dangerous contradiction emerged. Affordable housing began threatening economic stability itself, because falling property prices no longer hurt only homeowners. They endangered banks holding mortgage debt, pension systems tied to asset appreciation, consumer spending fueled by perceived wealth, government revenues dependent on real estate activity. Civilizations quietly developed an unspoken fear of declining home prices. That fear reshaped everything. Interest rates stayed lower, longer. Construction incentives changed. Political rhetoric shifted carefully around housing markets. Governments publicly promised affordability while privately fearing correction, because once homes became pillars supporting debt-based economies, reducing prices became economically terrifying. That is the hidden historical shift most people never fully saw happen. Shelter stopped being merely shelter. Homes became financial instruments. Civilization itself depended on, and once entire economies required permanent appreciation to remain stable. Affordability became almost mathematically incompatible with the SS system, which raises an uncomfortable question. What if the housing crisis is not happening because governments failed to stop rising prices, but because modern civilization quietly became dependent on them? Most people believe housing prices rise because of a simple equation. To many people, too, few homes, supply and demand, and on the surface, that explanation feels reasonable. Cities grow, land is limited, populations expand, more buyers compete for fewer properties, pushing prices upward. Simple, clean, comforting. But the deeper you examine modern housing markets, the more that explanation begins to feel incomplete. Almost like a story designed to keep people focused on the surface while something much larger operates underneath. Because beneath the visible housing market sits another system entirely, a hidden engine quietly shaping modern civilization itself. Debt. To understand modern housing inflation, you first have to understand something most people are never taught about money. Banks do not merely lend existing cash sitting inside vaults. Modern banking systems create money through lending itself. When a bank issues a mortgage, it is not simply transferring pre-existing wealth from one place to another. New purchasing power is effectively created through debt. The mortgage expands the money supply, which means something strange begins happening inside housing markets. The larger home prices become, the larger loans become, the larger loans become, the more money enters the economy. The more money enters the economy, the higher prices can rise. The cycle feeds itself. Housing inflation becomes self-reinforcing. And once an economy becomes dependent on that cycle, escaping it becomes extraordinarily difficult. Imagine a casino where homes are the chips, banks are the dealers, and governments quietly depend on the tables remaining open forever. At first, everyone appears to benefit. Homeowners feel wealthier as property values rise. Banks generate enormous profits from long-term debt. Governments collect taxes from expanding real estate markets. Construction industries boom. Consumer confidence increases because rising home equity creates the illusion of growing prosperity. But, like all systems, dependent on constant expansion, the structure becomes fragile because rising prices eventually disconnect from ordinary human income. And when that happens, debt quietly replaces wages as the primary mechanism sustaining affordability. This is why modern homebuyers increasingly borrow amounts previous generations would have considered unimaginable. 30-year mortgages became standard. Then came 40-year loans in some regions. In certain countries, families now discuss multi-generational debt structures where children may inherit financial burdens connected to housing itself. Civilization normalized enormous debt so gradually that most people stopped noticing how extreme it became. Then came the 2008 financial crisis. For a brief moment, it appeared the system might finally reset. Housing markets collapsed, banks failed, entire economies trembled. But instead of allowing debt structures to fully unwind, governments and central banks intervened. Aggressively, interest rates were slashed to historic lows. Trillions of dollars flooded financial systems through monetary stimulus and quantitative easing. The intention was stabilization, but the side effects reshaped housing globally. Money became extraordinarily cheap to borrow, and when borrowing becomes cheap while land remains physically limited, asset prices explode. Investors searching for yield poured capital into real estate because traditional savings accounts produced almost nothing. Housing increasingly appeared safer than volatile. Stock markets. Homes stopped functioning primarily as shelter. They became wealth preservation machines. In city after city, prices detached further from local wages because buyers were no longer competing only against neighbors. They were competing against global liquidity itself. And this produced one of the strangest paradoxes in modern civilization. Cities experiencing severe housing shortages often contain enormous amounts of empty property. Luxury towers rise into skylines, while countless units remain dark at night. Apartments function as investment storage rather than living spaces. Wealth moves invisibly through concrete and glass, while ordinary workers struggle to afford rent nearby. Scarcity and abundance exist simultaneously. At first glance, this feels irrational. Why build homes people cannot live in? But financially, it makes perfect sense.